we're going to take a closer look at the control features of the bank account. Remember, we were talking about cash primarily in this chapter because it is the most susceptible asset to fraud or misappropriation. So the bank and the company both maintain independent records of the company's checking account. Think about that in regards to your own. Now, if you are keeping an actual check register and then you get your bank statement, you can compare the two to make sure everything is copacetic. So that independent record from the bank's side contributes significantly to the internal controls over cash. It also minimizes the amount of actual currency, so actual dollars and cents, that need to be kept on hand. It facilitates the control of cash because a double record is maintained of all bank transactions, one by the bank and one by the company. And the asset account cash is maintained by the company as the flip side of the bank's liability account for that company. It should be possible to reconcile these accounts and make them agree at any given point in time. So included in bank account transactions are things like our electronic funds transfers, which are disbursement systems that use wire, telephone, or computers to transfer cash from one location to the other. This is quite often and typically is considered a better internal control since there are no actual cash or checks that are handled by the company employees. The importance is that the EFT's approvals are carried out by persons with sufficient authorization. So we're going to talk a little bit more in depth about the bank statements next. So bank statements. Each month, the company is going to receive a bank statement. Now, this could come in an actual paper form in the mail, or it could be available via online. And it's going to show the bank transactions and balances. Some of the transactions and the balances will be included are checks paid and other debits that reduce the balance in the depositor's account, deposits and other credits that increase the balance in the depositor's account, and the account balance after each day's transactions. Bank statements are prepared from the bank's perspective. So for every deposit that the bank receives, an increase in the bank's liabilities to the depositor will occur. So outside of the traditional checks, debit card transactions, electronic transactions in and out, deposits, ATMs, there might be service charges. There might be a chargeback because of an NSF check. There may be some collections of a notes receivable. There might be interest earned. These are some of the different things that the bank statement is going to show. Some of these will be already incurring in the company's records. Some of them may not yet be there and may need to be recorded. How we determine that is by doing a reconciliation. Because the bank and the company are keeping separate records, the two balances very rarely are going to be exactly the same. So what we do is we do a reconciliation. This is because of two reasons. One, there are time lags that may prevent one of the parties from recording a transaction in the same period. Days may elapse between the time a check is written and dated and the date it is paid by the bank. A day may pass between the time receipts are recorded by the company and the times they are recorded by the bank. And a time lag may occur when the bank mails a debit or a credit memo to the company, and the company records it. There also may be errors by either party in recording transactions that will come to light through the process of reconciliation. The incidence of errors is really going to depend on the effectiveness of the internal controls that are maintained by the company and by the bank. Now, typically, bank errors are infrequent. However, I have actually personally witnessed several of them over the years. So let's look at how we go about reconciling. What are the procedures to this? In reconciling the bank account, it's customary to reconcile the balance per the books and the balance per the bank to their adjusted cash balances. To obtain maximum benefit from a bank reconciliation, the reconciliation should be prepared by an employee who has no other responsibilities related to the cash. The reconciliation schedule is divided into two sections, as you can see here: balance per the bank and balance per the books. We engage in the following steps, and they should reveal all the reconciling items causing the difference between the two balances. We compare the individual deposits on the bank statement with the deposits in transit from the preceding bank reconciliation, with deposits per the company records, or copies of duplicate deposit slips. Deposits recorded by the depositor that have not been recorded by the bank represent deposits in transit and are added to the balance per the bank. We compare the paid check shown on the bank statement or the paid checks returned with the bank statement. That is less frequent now than it was back in the day, with checks outstanding from the preceding bank reconciliation and checks issued by the bank as recorded in the cash payments journal. Issued checks recorded by the company that have not been paid by the bank represent outstanding checks, and these are deducted from the balance per the bank. We note any errors that were discovered in the previous steps and list them in the appropriate section in the reconciliation schedule. All errors made by the depositor are reconciling items in determining the adjusted cash balance per the books. In contrast, errors by the bank are reconciling items in determining the adjusted cash balance per the bank. We chase bank memoranda to the depositor's records. Any unrecorded memoranda should be listed in the appropriate section on the reconciliation schedule. So we're going to illustrate an actual bank reconciliation. Here we have the bank statement for Laird Company, which shows a balance per the bank of $15,907.45 on April 30th, 2017. On this date, the balance of cash per the books is $11,709.45. So they have these following reconciling items. There are deposits in transit. There's an April 30th deposit that was received by the bank on May 1st of $2,201.40. So this means that in the company books, it says April 30th. The bank reports will say May 1st. There's some outstanding checks. So these are checks that have been written but have yet to be paid by the bank of $5,904. There's an unrecorded electronic receipt from customer on an account on April 9th that we see on the bank statement. And then there's some unrecorded charges determined from the bank statement. So we had a returned NSF check on April 29th of $425.60. We have debit and credit card fees on April 30th of $120. We have bank service charges on April 30th of $30. And then we noticed an error. Check number 443 was correctly written by Laird for $1,226 and was correctly paid by the bank on April 12th. However, it was recorded in the books at $1,262, which is a $36 difference. So we start with the cash balance per the bank. We add the deposits in transit. We reduce the checks that are outstanding. And that gives us, next we're going to go to the electronic funds transfers that were received. So these had not been recorded in our books yet. We have the error, so we need to correct check number 443. We need to remove NSF check that was received for $425.60. We need to remove our debit and credit card fees and our bank service charges. So our adjusted cash balance per the bank is $12,204.85. Our adjusted cash balance per the books, $12,204.85. Now, it's not unusual that every now and then you won't actually come out true. Sometimes when there are a lot of transactions that occur, you don't necessarily see something like that error where it's flipped, where there was a transposition of the numbers. Once we've completed the transaction, each reconciling item used in determining the adjusted cash balance per the books needs to be recorded by the depositor in their books. Now, if these items are not journalized and posted, the cash account will not show the correct balance. So we had the payment on the account by a customer of $1,035. So we received cash of $1,035. To the accounts receivable account. Next, let's look at the book error. So for the book error, the cash disbursements journal shows that the check number 443 was a payment on an account to Andrea Company, who is a supplier. The correcting entry would be to add cash of $36 and then reduce the accounts payable account by $36. Now, we received a check against our accounts receivable and we deposited it. When an NSF check becomes an accounts receivable to the depositor, the entry is we post it back to the accounts receivable and we reduce the cash. They still owe us $425.60. We recognize the bank charge expenses for processing our debit and credit card transactions. That typically goes to bank fees, bank charge expenses, something along those lines. We reduce our cash by the appropriate amount. I'll go ahead and leave this up here for just a minute. Go ahead and pause the video so you can read this. This is really something that everybody probably has some knowledge of, maybe not a lot, but you've definitely heard about Madoff and the Ponzi scheme.